Want new ideas of what to buy in FY26? In this series, we're sharing our best ideas for the financial year ahead. And today we're looking at alternative assets. Welcome to Get Started Investing, a podcast where we help you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
Bryce, I'm good. I'm excited for this one as the new financial year gets closer. We're unpacking some of our best new ideas for the year ahead. How could I not be excited? Today we're talking alternative assets. Let's bust some jargon straight up. What is an alternative asset?
Alternative assets are anything that are not included, I guess, in...
Any assets that are alternatives.
Yeah, like not included in, I guess, traditional assets. So stocks, property, bonds, cash.
Technically, property is an alternative asset.
Stocks, bonds, cash.
Yeah, stocks, bonds, cash.
Yeah, so those are like your three foundational asset classes that have stood the test of time, that have, I guess, have been traditionally the most accessible and people have invested in. Alternatives is everything outside of that.
Yeah, it's too broad a definition for it to remain like that forever, but that is what it is now, because traditionally all of those other asset classes were harder to access, especially for investors like us. And so the asset classes we're talking about here are things like private equity, private credit, real estate, commodities. Well, traditionally crypto. But crypto, infrastructure, venture capital, hedge funds.
Yeah.
The alternative space is massive. It's not a majority of the market, but it's like
Huge.
it's a big chunk of the market.
Huge.
And so it's a vast universe, which the really exciting thing for people like you and I is it's becoming more accessible.
Yes.
And it's two main ways it's becoming more accessible. The first is that there's a number of stock market listed options that we can now invest in. And so that's things like ETFs that own property or that own gold or whatever it is. And the other one is that the asset classes themselves, they're finding ways to either reduce the minimum investment required. So that might be for something like private equity, or the asset class is just becoming more accessible because of technology. And the classic example is things like cryptocurrency, which are just by their nature more accessible.
Yeah.
Yeah.
So that's what we're going to unpack today. 2 ideas each with alternative assets. But before we do, Ren, a huge thank you goes to our long-term partners here at Get Started Investing, BetaShares Direct.
Yeah, looking to invest your way, BetaShares Direct makes it easy.
There's zero brokerage on over 300 ASX shares and all ETFs. And you can choose from over 10 ready-made portfolios or build your own from scratch.
Automated investing means you can set, forget, and grow. With simple tax and performance reporting, staying on top of your money has never been easier.
It's a platform unlike anything else here in Australia. Search BetaShares Direct and set up your account in minutes.
BetaShares Capital Limited is the issuer. Consider PDS and TMD at betashares.com.au and to see if the product is right for you. Investing involves risk.
Alrighty, well, scissors, paper, rock to start. I guess I'll go first.
Well, as every episode in this series, you've taken the lead.
Well, it would be rude then to change things up. I'm going to talk about an alternative asset class that is unfortunately still somewhat difficult for us as retail investors to invest in, but for me is a very exciting one, and that is private equity, Ren. Private equity at its core is buying businesses that are unlisted, or investing in funds that go out and buy businesses that are unlisted.
Or taking businesses that are listed and available for everyone to invest in and making them unlisted and available only for those who are in the fund to invest in.
Yeah, then they improve those businesses and they go on to sell them. So why private equity? There are a few reasons for me, Ren. The long-term returns are appealing. Over the past 20 years, private equity has actually outperformed public equity markets by around 2 to 4% annually. I think on average, it's about a 16% annual return over the last 20 years. One of the big trends we're seeing is, particularly here in Australia, but globally, less companies are listing on stock exchanges and more are staying private for longer. So the opportunity set, we need to think beyond what is just publicly listed.
Yeah, and like the classic examples that we all think of are companies like Canva, Stripe, SpaceX.
Exactly.
Companies of that size traditionally would have to list.
Yes.
Like just to give their investors liquidity and to be able to raise more and more money as they get bigger and bigger. But these days, the private markets are so big that they don't need to list.
Yes. Yeah. There is some sort of less correlation to public markets because you're not getting like minute by minute price changes. There's I guess, less correlation to public market price movements. And it's a slightly different type of investing. You're investing in sort of business transformation at its core. That sort of speaks to the returns as well. So that's sort of like why. The how becomes a little bit tricky because a lot of the good fund managers and ways to access private equity in its truest form is unlisted at the moment or requires very big minimums. But there are some listed companies and funds available. So I'll start there. You can invest in some of the world's biggest private equity players over in the US. Blackstone, KKR, Carlyle, Apollo. They're like 4 of the world's largest private equity players. To give you some numbers, Blackstone has returned almost 140% over the past 5 years. KKR, 322% over the past 5 years. Apollo, 174% the past 5 years. Carlyle, not as impressive, up 60% in the past 5 years. But these are funds that you can invest in, and their mandate really is using the billions and billions of dollars they have under management to go out, buy companies, turn them around and spin them off. So you can get listed exposure that way. Here in Australia, there are a couple of opportunities. There's the Pengana Private Equity Trust. The ticker is PE1. It's actually had some pretty poor performance, so I'm not so excited about that. But there's also the VanEck Global Listed Private Equity ETF, GPEQ. Since inception, it's done 20%. It gives you access to listed private equity companies. So you can get access through public markets, but as Ren said at the top, a lot of players that have traditionally been private and have high minimums are now starting to lower their minimums so it becomes more of, accessible to retail investors. One that I have my eye on is the Schroders Specialist Private Equity Fund. Now, this is a fund that goes out and targets the small to mid-sized part of the market. They also invest in other private equity managers. They've had a return of 16% per annum, which is net of fees, and a cumulative return of about 114%. It is a $20,000 minimum, something that I'm working towards, but I do have my eye on this one as a private equity play.
Nice. Love it. All right. Well, my first alternative asset, not trying to reinvent the wheel here, not trying to get too cute by a half. Let's go with the world's oldest asset class that has been one of the world's best performing asset classes, gold. Nice. Why gold? I mean, there are reasons why people include gold in their portfolio. It's a hedge against inflation, so it holds its value as the dollar gets eroded in value. It's also a hedge against like market risks and volatility or like a recession or a crash. But it is rare that your hedge does better than your main investment. Your hedge is normally meant to take some of the risk off the table.
Yes.
When you're building out an investment portfolio. But in this case, the hedge has done really well as an investment in its own right.
Yes.
And depending on what time frame you look at, it's done arguably better than the stock market.
Uh-oh.
So since 2000, gold is up 1,000%. The S&P 500 is up 485%.
Wow. Is that AUD?
These are all US numbers.
Okay.
Yeah. Now, if you think back to the year 2000, that is kind of cherry picking your time frame.
True.
Because it's like the peak of the dot-com bubble.
Yeah.
So, okay, let's not use 25 years. Let's use 20 years. Well, over 20 years, gold is up 622%. The S&P 500 is up 571%. So gold has still done very well in that time frame. And you say, not the time frame I want to look at. Well, then I found 15 years, gold starts to underperform. So 167% for gold, 411% for S&P 500. So look, there was a lot of numbers there. Regardless of the time frame you choose, the point that I want to make is that gold has been a strong performer in the portfolio. Over the long term, it isn't like a major detractor from your portfolio. If we think about the range of outcomes that could eventuate in the year ahead, a lot of them could see gold do quite well. So some of the range of outcomes is we see a restart of inflation because of tariffs, if Trump actually sticks to some of these tariffs that he's putting on. But also if we do see a recession, if we see global economy slow down because of trade uncertainty, not even a trade war, just like businesses pull back on investment, consumers pull back on spending, and we see a recession because of that, again, gold potentially does well. So gold has come a bit off. It did hit all-time highs. It's come a bit off. If you're thinking about some of the risks in the economy at the moment, gold wouldn't be a bad place to just have a little bit of your portfolio. And then if some of those risks do eventuate, you can sell the gold, free up some cash, and buy when stocks are low. So then the question is, how do you buy gold? And you can physically just buy gold, but it's not the easiest way to do it. We did an episode comparing some of the ASX listed gold ETFs because there are a few different types, and our favorite is physically backed gold ETFs. And you can listen to that episode to hear why. We'll include the link in the show notes and YouTube description. But if you're just looking for some names, Global X physical gold ETF ticker is gold. BetaShares Gold Bullion ETF, the ticker is QAU. Van Eck Gold Bullion ETF, the ticker is NUG, NUGG. And then the Perth Mint Gold ETF, PM Gold, are some names that you can look at. So that's gold.
Love it. And for me, look, you just can't forget Bitcoin.
No one is forgetting Bitcoin.
Well, just like gold has been an incredible performer, an inflation hedge, all the reasons that you spoke about, Bitcoin is the gold of the digital era, and it has been an incredible performer. 2010, it was 10 cents. As you said, May 2025, it hit about 110,000. That's a compound annual growth rate year on year of 153%.
Yeah, but you can't, yeah, sure.
Now,
okay.
Of course, that's not going to continue. It has arguably been one of the best performing asset classes. I think from here, it would be incredibly foolish to assume that that growth rate continues. But there are a lot of great tailwinds behind Bitcoin. For me, this is not investing though. This is just sheer speculation that people will continue to see it as a store of value and be prepared to pay more for what I bought it for. It's not spitting out any income. It's not growing or producing anything. So it is speculating. But for me, it is going to continue to be part of my portfolio. How I will be approaching it in FY26, at the moment, it's about 10% of my portfolio. I don't want it to be more than that. So I will be opportunistically buying when I guess I have those opportunities. If it falls,
So you're not going to just be dollar cost averaging.
No.
Okay,
No.
that's interesting.
Yeah, I've thought about it. But for me, the way I've played it for the last few years has just been buying when it tanks. And so I think that's something that I'm just going to continue to do because, as you said, I think at the top of this show or last episode, like there are moments where it really tanks.
Well, yeah, in April after Liberation Day, it dropped to 75,000 US dollars.
Yeah.
And then within like less than 2 months, it had jumped 50% and was hitting all-time highs above $110,000.
Yeah. So it can move quickly, but I think historically there's been times where you can just look at it and say this is a generally good time to buy. So yeah, that's how I'm going to approach it. Just kind of keep it at that weighting. Go from there.
All right. Well, I'm going to close it out. They say save the best to last, and that's why I will close out this series. My second alternative asset is farmland.
Okay.
Now, you might be asking why farmland. Well, some data got released recently that found that Aussie property prices may be good. Aussie residential property may have done well, but Aussie agricultural land has done far better. So over the past 20 years, residential housing as an asset class is up 154%. Not bad. More than doubled your money. But agricultural property values across Australia are up 256%. So you more than tripled your money. I mean, the best performing farmland across Australia, parts of Western Victoria, up more than 800% in 20 years. So compare that to the Aussie stock market. The All Ordinaries in that time is up 93%. If you had reinvested your dividends over that time, it's up 372%. So side note, reminder, reinvest your dividends.
Yeah, it's crazy.
But agricultural property has done well, and all of the tailwinds you would think would continue. Yeah. So the question is, how do you express that through the ASX? Like how can people like you and I buy it? There's only one agricultural focused real estate investment trust in Australia. It's Rural Funds Group. The ASX ticker is RFF. Now, since listing in 2014, it's up about 150%, so not bad, but it has had a tough run of it lately. It's down almost 50% since its highs in 2021. And so like it's not a perfect way to play farmland because it's a company and there's always risks about company with management and the assets they buy or something like that. It's not like you're just getting exposure to the asset class in the same way that you do like gold or Bitcoin. But the assets they buy, you know, at least according to them, it looks like they are undervalued based on their current market value, I guess is how they would describe it. So they net assets, so assets minus debt, they have $1.9 billion in assets, which is the farmland they own. And their market value at the moment is $688 million.
All right.
Yeah.
Nice.
So that's interesting. I think what they do with their farmland is they then lease it out to operators. Nice. So like some ASX listed operators as well, like Select Harvest and stuff like that, will then lease land off them. So I don't own it and I'm not running out to buy it. But when I came across those stats around the performance of Australian farmland, it is something that I just looked up and did some research on. This is the only pure play agricultural land REIT in Australia. And so I just added it to my watch list as a company that I am interested in following for a little bit and getting a little bit more familiar with. So that's the caveat there. But farmland as an alternative asset, I thought was worth bringing to the table.
We should crowdfund an Equity Mates block of land somewhere in Western Victoria.
You just want the community to buy you land.
Yeah, come on, who's in? Love it. Well, there you go. So we've covered off private equity, we've covered gold, we've covered Bitcoin, farmland, plenty of alternative assets out there. There also are a number of listed ETFs available. One comes to mind is the Wilson Asset Management. They have an alternatives fund. We've actually interviewed them. Think about your infrastructure funds. There are plenty of ETFs that do give you access to active managers who are playing in the alternative space. So do your research because, as we said, this is now becoming an increasingly larger part or opportunity set that you can be adding to your portfolio outside of the traditional stocks and bonds and cash. Well, Ren, that brings us to the end of our series, New Ideas for FY26. We've covered off 12. But my God, there are so many more.
Yeah, it's a reminder of how much opportunity there is. And it's a reminder that if you are on the fence about getting started or you know people in your life who are on the fence about getting started, now is the time. And the best place to start investing is with us here on Get Started Investing. So make sure you're subscribed wherever you're watching or listening. Make sure you send it to people in your life who should get started investing. The first 12 episodes of this series are a great place to start for anyone. It's when Bryce and I peaked. Yes. So go and check that out if you haven't already.
Well, that's it. Stay with us. Next episode, we're covering off tax tips to close out the financial year. But that does it for us here at Get Started Investing.